the yen, buying the treasuries, and doing SOFR spreads to mitigate the interest rate risk, and then taking the borrowed money on the treasuries and using it as collateral to, say, buy stocks. Well, it's like a four-legged trade. I'm really simplifying it, and I'm probably not getting it right, but I want you to understand it's really complicated. It's understandable, but the key is these are hedge funds doing it, and they're leveraged 20 times, some of them, as much as 20 times is the actual quote. So a 20 times hedge fund leveraged into these things, they're leveraged into them because, hey, it's US Treasuries. There's nothing safer. Well, the rest of the world doesn't think they're safe anymore. And so even if you fear Japan and China and Europe are selling US bonds while they're selling US stocks, well, you're going to get a margin call. So if the dollar is dropping while bonds are dropping, while stocks are dropping, isn't that the opposite of American exceptionalism? That's a withdrawal. And we've talked about this before, just parenthetically, if zooming way out again, if the world is repatriating, I'm sorry, if the West is repatriating supply chains, onshoring, reshoring, friendshoring, however you look at it, then the rest of the world is inclined to repatriate payment chains. And payment chains are your own currency. Payment chains are, well, if they're going to be rebuilding their supply chains, then we have to rebuild our infrastructure. Europe is doing it. NATO is one of their catalysts. Japan is doing it. Well, they have inflation to contend with now. And so they want to, it's part of rebuilding their economy. And China has been doing it for 10, 15 years. So, all right, so zooming back into where we are, at the level we are. So Trump is looking at the bond market going, holy shit, it's dropping. And it's dropping because of me directly, right? On top of that, his approval rating is dropping. Now, if you want to look for one thing that he needs to hold to keep the rest of the GOP in line, it's his approval rating. Because with a high approval rating, senators and congressmen at midterms will be more apt to stick by him. He can endorse them and they can get reelected, right? It's a big help. But if your president is not liked, even by your own base, well, an endorsement by Donald Trump isn't necessarily going to help you. So imagine you're a congressman or a senator, and you're in a position where you have to run against your own president. And that happens from time to time. But if that happens, this time, Trump's whole plan, or Scott Besant's whole plan, goes down the toilet. It's kind of that simple. So, going back to Trump, you're looking through his eyes and you go, okay, stocks are down, that sucks. Bonds are down, wait a minute, that sucks. And then you get scared of it. And you say, all right, oil's down, dollar's down, that's not enough to make me happy. Oh shit, my approval rating is down. Well, if his approval rating is down, then the rest of the GOP won't listen to him. And if the rest of the GOP won't listen to him, he can't get his tax reform pushed through. He wants to cut corporate taxes, and he wants to cut income tax, citing tariffs as a reason for it. Hey, if I'm bringing in money from tariffs, we don't have to tax as much, which is why I call him a horse trader. He's a horse trader. He's always going from one person to the other, figuring out what they want and trying to satisfy them. You need this, I'll get that from this guy. What does he need? And so you start running around looking for things. And it's a very aggressive way to do deals. And you're kind of putting it all together. And it's not easy. If you do well, you pull it off. If you don't do well, you're viewed as a salesman who doesn't keep promises. Now, think about this. If the bond market and the rest of the world is pulling its money out because of the tariffs, and the tariffs are the thing that's going to allow him to get taxes lowered, right? The success of the tariffs gets taxes lowered. And if those things are going against him, then he can't get the taxes lowered, which means he has to pull the tariffs back. And if he pulls the tariffs back, then he can't get the taxes lowered. See, it's really really bad. And that's horse trading. Horse trading is when one negotiation falls apart, all of your promises fall apart. Now, I'm not shitting on it. I'm saying that's his style. And his style is very dangerous that way. The problem is he goes from a mandate to a lame duck if this continues. Now, keeping all that in mind, what did he do last week? Well, he backed off on the tariffs. The expression they're using is an executive pivot. So he pivoted. He backed off on the tariffs and he threw them out 90 years or something, 90 days on the yield curve. So he basically put them in timeout. And without having an opinion on what's going to come, what's happened is by throwing them out 90 days, he signaled to the world, well, at least to the US, that he's pivoting, meaning he's backing off. Maybe he's going to look for some way to change it, adapt it. Maybe he won't do it again at all. Who knows? But, all that stuff is on pause because the bond market, combined with the stock market, combined with the approval rating, jeopardizes everything. So, and increasingly, when he's in that situation, he's held hostage by not only the GOP, but from Powell, right? So whatever accord that he has with Powell, and I do believe he does have one with Scott Bessent, is probably about to start crumbling. Mind you, last week he did call for lower rates, but he didn't call for lower rates the way he normally does, berating Powell for not doing his job and stuff like that. But he's going to start. He's going to start. So what's Powell going to do? I don't know. But let's go through the actual report. I want to give you, that's the whole framework. And that's why this quote here is very important. The bond market is the world saying you're wrong. And the electoral base is the domestic voters saying you're wrong. They're now pressing the U.S. trade policy for reversal. Part of the congestion is it is allergy season for me. All right, so hopefully that'll cover most of the extemporaneous discussion, the framework anyway. Scores on the doors, gold 19.5%, government bonds minus 4.3%, investment grade bonds 2.4%, cash 1.2%, high yields 0.2%. Can't believe they're positive. Commodities minus 5.5%, stocks minus 6.2%, US dollar minus 7%, oil minus 16.1%, crypto minus 38.8% year to date. Oh, there's one other thing that I think is really significant. 2 or 3 reports in a row, he's now referring to the dollar as being in a secular bear market, and he's right. Trump's inability to do this, if his whole, horse trading falls through, there's only 2 things we can do then. We can get the dollar to zero to help make our debt less of a problem, which means domestic inflation. And we can offset that domestic inflation by getting oil down, however we're going to do it. But that puts the dollar, we're going to debase our currency. If he can't pull it off, that's what's going to happen. All right, so here we go. Zeitgeist. I wouldn't want to be a waiter in Boca Raton tonight, a retired investor on the Muni Bond Meltdown. Muni Bond Meltdown is a domestic issue, and although I don't know what it implies, I will say it implies that local governments and local retired investors who vote for Trump are going to be pissed, right? A lot of these people depend on munis. Anyway, Zeitgeist 2, Musk owned the long end in Q1, and now the long end owns Trump. Second part's obvious, right? In Q1, Musk reducing, the whole Doge thing, which is going to be pushed back against. But the whole point is the bond market liked it, and the bond market rallied. And now the long end owns Trump. So that's a little clever statement there. The biggest picture, U.S. exceptionalism is ending, U.S. repudiation starting. End of an era of U.S. buys the rest of the world's goods, and the rest of the world buys the U.S. treasuries. Buyer's strike of U.S. assets. Foreigners own 33% of U.S. treasuries. Chart 2. Let's go to that. 27% of US corporate bonds, 18% of US stocks. And that's why he says the dollar is it's in for him, a secular bear market. US yield curve is set to steepen. Old S&P valuation floor of 20 times is now the new ceiling. We'll look at that in a second. Chart 2, right-hand side, households, rest of the world, pension funds, financial sector, government. So the government owns 24% of its own bonds. The financial sector, I assume someone asked that on the chat, that the financial sector is it American or international? I'm going to assume it's American. Pension funds have very little U.S. bonds. I want to come back to that. Rest of the world, large, and households starting to grow. The rest of the world is 33%, and that's pretty big. And if you look at it since 1965, the rest of the world has been growing in its trust of U.S. bonds as we've spent more money on them. I want to look at the pension one, though. Pensions, which govern retiree money, no longer buy U.S. bonds. Look at the change. Now, it doesn't look significant in the last, say, 10 years, but understand that pensions are chasing income or chasing appreciation because they expect to make more. Let me just say it this way. As more and more people retire, pensions that are underfunded have to chase more and more speculative products and assets to make money to be able to pay them out. And so pensions are buying, I'm making it up, but pensions are buying crypto and PE companies, instead of US bonds. And so if you're thinking they're going to buy US bonds after this, think again, because they're still chasing, and they're going to chase until they need to be bailed out. Now, if they buy US bonds, it's because they were mandated by the government. Anyway, I just think that's significant. It's a sign that our retirement situation, the rest of the boomers and the older Gen X like myself, as we retire, that's going to be a problem. I don't have a pension. Let's put it that way. All right, so here we go. What's the second part of that? The old S&P 500 valuation floor of 20 is that the new ceiling? It's kind of a hard chart to see, I think. All right. Between 1900 and, say, 2000, that light blue line there, that was looks like the mean of 14 times governed the S&P 500 in terms of a PE. And then 20, starting in, say, 2011, became the ceiling. So now it looks like it's going to be the floor, he's saying. If you look at it, it's basically channels. Probably going to be relevant, but not today. All right, we'll come back to that. I'll leave that chart up there. You can look at that in a second. All right. Long twos, short SPOOs. Higher U.S. yields, lower stocks, lower U.S. dollar, driving global asset liquidation will likely force policyholders to act. Policyholders means Trump, who already acted, Powell, who should act, and Bessent, who's probably going to work in conjunction with Powell. But we sell the rips. We're long the 2-year treasuries. We're short the S&P until either A, the Fed cuts hard to break liquidation cycle, or B, Trump and Xi pause the trade war to reverse global recession momentum. We still think the SPX at 4.8K is the right level to buy risk assets if policy panic makes recession short or shallow. He elaborates on that as we go further down. I'm going to skip the weekly flows, only because I'm congested. Flows to know. Treasuries. Biggest inflow ever, high yield bonds. Finally, biggest outflow ever. bank loan, and investment grade bonds. Okay, so this is interesting. The tips market is getting inflows, which doesn't make sense to me, but it may be because everyone expects real rates to drop. And it's not just retail doing that; institutionals are doing it as well. Equities still an inflow. Haven't had an outflow yet. Okay. Financials usually lead in stock outflows, and now we have the biggest outflow ever. Foreigners selling U.S. equities. Chart 6. Where is that? Did I miss that chart? I did. Hold on. Foreigners selling U.S. equities. There's a chart. Yeah, there you go. They're selling U.S. equities. And when did they do it last? Well, they did it in 23. Not sure why. And they did it in 20. Right? So there's your payment chains being repatriated. Right? We need to get our money home. What happened to gold then? What happened here? Not sure what happened here. You would have thought maybe it would happen with the oh, I get it. That's right.